I think there's quite a bit of room to raise interest rates without threatening the labor market. This is, by so many measures, a historically tight labor market.
The Fed is independent, and we stand by that, as does the president. That the Chairman Powell has indicated his plans to recalibrate in the past, and the president spoke last week to his support for that.
This is not a Federal Reserve that's going to go out and try to surprise markets. That's why this notion of a 50 basis point rate hike is highly unlikely.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Rome, and here's what's coming up on today's program. Fed liftoff. Jay Powell bakes in a March hike and does not rule out tightening at every meeting this year. Global stocks tumble on the Fed's hawkish tilt. Wall Street looks set for losses. And deadlock in Rome. The third round of Italy's presidential election yields no winner. Voting resumes today. So Jay Powell says the Fed, of course, is ready to raise interest rates in March to tackle the highest inflation in a generation. Now, he's not ruling out moving at every meeting.
We'll make a decision whether to raise the federal funds rate. I would say that the committee is of a mind to raise the federal funds rate at the March meeting, assuming that conditions are appropriate for doing so.
I have to say there has been price movement in the last hour or so. Money markets now fully pricing in 5 rate increases, actually from the Fed. Traders now trying to recalibrate their positioning after what we heard from Jay Powell yesterday. Now, for more on the market reaction, let's get straight to our editor, Christine Aquino. Christine, so what exactly are we seeing on the markets? How's it playing out?
Well, Francine, you know, the sea of red that we started here with Europe is starting to ease just a little bit, you know, but we're still very much in the red. And of course, it's the sectors that you would expect leading the sell-off in Europe. Of course, I'm talking about these consumer-sensitive sectors, these tech sectors that are really leading the losses here. The DAX, of course, very much on the back foot today, and that's primarily because of SAP dragging that entire index down, very much in line with the tech sell-off theme. And of course, looking across other asset classes as well, we're seeing the dollar once again resuming that relationship with higher U.S. yields and rising today. It's not overly strong, though. I note that it was only up about 0.3% this morning, and that's actually giving a bit of relief to emerging markets. We're seeing a bit more calm there, still in the red, but not as much as you would expect. And certainly currencies like the ruble and the rand topping some of those emerging market currency gains. We're also seeing a little bit of relief in EM stocks this morning. We're seeing some of those losses really easing from where we started with at the start of the European session.
So, Christine, talk to me a little bit about the flattening yield curve. By historical, charts, it will flatten further, but actually there's this unknown of how the markets will interpret QT.
Absolutely, Francine. And it really just speaks to how this idea of the yield curve as an economic signal, as a signal for how markets will price in future policy is really quite broken now, because what we have here is kind of this double mechanism, right? It's first the idea of the Fed raising rates, yes, but then they have this other lever of QT, and it's really questions around how they're going to manage that process. Which maturities are going to, will they start rolling off first in that process? Is it going to be MBS, or is it going to be more longer dated treasuries? And this uncertainty is really kind of breaking what we previously know about the yield curve, and this idea of what a flattening yield curve means. I think we have to chuck that out the window and rethink this interpretation, and now that we have this double tightening sort of price action or double tightening action that we might potentially see from the Fed this year.
Christine, thank you so much. Christine Aquino there, our markets editor. Now we're talking a lot more about the markets. We're joined by Rebecca Chesworth, senior equities strategist at State Street. Rebecca, thank you for joining us on such an important markets day. What does this do to your 60-40 construction? How should markets and actually equity analysts look at this?
Goodness, yes, I'm so glad we're the other side of the decision now. So I thought it would be a much easier day today, but as you say, there's still a lot of things in move. I think what we're going to see today is some readjustment. We're going to see a continuation of the move that we've seen since the pivot, the Powell pivot in December. So I think there's going to be two reactions. There's going to be a very short-term one when we start to see some of the trades that we've seen so far this year playing out. But there on in, people will think about, well, what about the rest of the year? And we're likely to have a calm part to the market until we get closer to the next meeting. And therefore, I think people are going to feel more able to go back into equities. We've certainly seen a lot of trades so far this year. We've seen a really busy start to the year in terms of ETF volumes. So I think we're okay on equities. I think on the other side of the equation, on the fixed income side, I think there are more questions to be asked. And of course, the yield curve becomes very important there.
Absolutely. Rebecca, have you had to actually reprice how many times you're expecting the Fed to hike this year? Or was the message from, Jay Powell quite comforting because he says, look, when you look at inflation, we'll try and do everything we can to keep it under control, but also growth will be, pretty strong, and that's a positive.
I mean, certainly we've had to reprice. We've gone up rapidly. We're now seeing a market that's expecting 4.5 hikes. Now, even the most hawkish weren't really there yesterday, so that is a big change. But the other side of the equation, and we will likely see this coming maybe later in the afternoon in this session in the US, is that people will then think, hang on, we've heard some good things about the economy. Clearly, Powell thinks that the consumer balance sheet is okay and that employment is quite strong. So on the one hand, we do have this worry of what those rates will do and that tightening will do to growth. On the other hand, we have a solid economy. And I think the other thing that we're ignoring today, and we've ignored the last couple of weeks, are those very strong results that we're seeing from companies.
So, Rebecca, where do you see the most value? Have you changed to the way you're positioned in certain equities? So are you stock picking, or are there actually sectors that look much more attractive because the Fed is more hawkish?
Well, it's interesting because a lot of how we thought this would play out has already happened. So if you think about the sectors that usually react well to this kind of environment, so energy, financials, we've seen a lot of that in the price already, and we've seen technology come off. Now, I think for the short term, we're going to see that exaggeration continue. So we're going to see a little bit of dispersion continuing between the sectors. But then maybe investors start to, as I said, look at the results, look at areas such as consumer discretionary in Europe, excellent results from luxury goods companies, supply chains improving for the autos, starting to see travel companies feel a lot more bullish. So some very interesting results, people focused down in that area, maybe industrials, supply chain improving, etc., infrastructure going up. So some interesting areas still in the market.
Rebecca, thanks so much. Rebecca Chesworth there, Senior Equity Strategist at State Street, joining us this morning. Now, we'll have, of course, plenty coming up from that Fed put, what that means for the markets going forward. Also, we have news from the Sovereign Wealth Fund of Norway. They returned some $176 billion in 2021. So we'll have a full breakdown of, for example, what they're doing, of course, in some of the space that we've been following. So getting away from oil into more ESG. That Sovereign Wealth Fund returning some 14.5% in 2021. Now, later on, don't miss our interview with the Norwegian Sovereign Wealth Fund Chief Executive Nicolai Tangen. He's at midday UK time. Coming up, but we'll focus on Italy. Deadlock in politics, Italian style. Lawmakers failed to overcome an impasse in the race to elect a new president. We'll have plenty more on that from Rome next. This is Bloomberg.
We are indeed short a decent amount of Russell 2000s. So we haven't been hurt in the last year, which is amazing. We're also short about half as much again as in the NASDAQ, which did hurt us, but not sensationally.
Well, that was Jeremy Grantham speaking in the latest Bloomberg Front Row edition. I think that episode will be out in a couple of days. Let's quickly check on the markets because we're definitely seeing a repricing of after what we heard from the FOMC and Jay Powell yesterday in the last hour or so. We've been checking, of course, money markets, and what we're seeing overall is now they're fully pricing in 5 rate increases from the Fed. Again, traders are trying to recalibrate some of these bets. from Jay Powell after he struck a hawkish tone at the meeting yesterday. I guess now there is no doubt that price stability takes precedence over other policy goals. What that means is that there's an upside risk of 6 hikes this year. That's at least according to our Bloomberg Intelligence's analyst Anna Wong. Now let's get straight to the Bloomberg First Word News. In London is Leanne Gerrans. Hi, Leanne.
Hi, Francine. The US has delivered Russia a written response rejecting most of its demands over Ukraine. Moscow wants NATO to withdraw its borders and close the door to Ukraine, possibly joining the organization, but that is being refused by Washington. Secretary of State Antony Blinken says the US is still open to talks and he's expecting discussions with the Russian foreign minister in the coming days.
It remains up to Russia to decide how to respond. We're ready either way.
In England, face coverings and COVID passes are no longer legally required from today as Plan B rules introduced in December are relaxed. Denmark, meanwhile, is to end virus restrictions next week and reclassify COVID-19 as a disease that no longer poses a threat to society. The move comes despite record infection levels in the Nordic nation. The EU is set to launch a case against China at the World Trade Organization over what it calls coercive practices against Lithuania and some exporters from other member states. China started blocking Lithuanian products at the border last December in a dispute over Taiwan. Chinese customs data shows imports from the Baltic state fell by 90% last month. And US Supreme Court Justice Stephen Breyer is retiring at the end of his term, giving President Biden a chance to fill his first vacancy on the court. Breyer was appointed by President Clinton in 1994 and is the court's oldest justice at 83. Biden has stated his intention to nominate the first black woman to the post. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. It'll be really interesting to see what President Biden actually does with that Supreme Court judge nomination. Now, Italy remains in deadlock after 3 failed bids to elect a new head of state, a new president of the republic, with a majority of voters leaving their ballot blank. Now, Wednesday's vote recorded a surge in support for the outgoing president, Sergio Mattarella, who's repeatedly, though, said he is not up for a second mandate. Meanwhile, Italy's relations with Russia, of course, are in focus, and that's after Italian executives ignored Prime Minister Mario Draghi's appeal to not join a conference call with the Russian President Putin on investment prospects in Russia. Well, we're now joined to talk about all of these various political strands with Giovanni Orsina. He is director of the School of Government at Lewis University here in Rome. Thank you so much, Professor, for joining us. And first of all, I know you're also Roman, so what a beautiful city you have. I don't know whether people are actually listening to anything that's happening in the Quirinale or the Senate because they're just looking at the view. The focus is firmly on what's happened with Russia. And I wonder whether, as we're in this political stalemate, and it's very difficult to understand why these executives, still got on a call with Vladimir Putin, despite the government saying, please don't do that. I mean, are they just distracted because they're electing a president?
I don't think that is exactly the case. I think this is a more, let's say, more general game of economic relationship and political relationship. I don't think this is because the stalemate has weakened Draghi. I think more of a complexity of the decision-making process within the Italian system.
And if you look at trade, certainly between Russia and Italy, it's increased 54%. I know the number of goods that Italy is selling to Russia has also increased. Does this really go to the heart of this complex relationship that a country like Italy has? So trying to put pressure on Vladimir Putin whilst at the same time, I guess, needing that trade relationship.
Exactly. I mean, this is not just a problem of Italy, of course, it's a problem of all European countries, but certainly in the Italian case, this has been a problem for a long period of time. There is an important commercial relationship with Russia, and there is the energy sector, which of course in Italy, like with all other countries, is very relevant. And of course, there is, in general terms, which is not related to Draghi, a problem of political ambiguity and political weakness of Italy that is still, as many other countries, trying to find its way in this changing world.
But is Vladimir Putin, actually using that and certainly putting pressure on companies to put pressure then on their governments to be more lenient?
That makes a lot of sense. Of course, this is the case. Of course, in this case, this meeting had been planned way in advance. So one of the arguments is this is a kind of yearly meeting that had been planned in advance. But of course, given the situation, political wisdom dictated that it should be suspended. So of course, this is a way for Putin to exploit the weaknesses and the divisions inside, in this case, inside Italy. But again, we have seen this happening not just in this country.
Professor, so it's the fourth day of voting for the Italian president, the president of the Republic. We're none the wiser on who will become the president. We actually don't really know if another name will urge up in terms of consensus. Are you confident that Mario Draghi will stay either as prime minister or president? Because this is what the market wants. Mario Draghi in some kind of role in an Italian government.
This is, of course, the game that is being played. So the idea is to try and find a solution that can make Draghi happy and establish his position either as president or as prime minister. I think that the possibility for Draghi to be elected president are still there, and somehow I think they've been growing in these last hours, because all the other candidates in these last hours have grown weaker. So there is still the possibility that, say, today or the day tomorrow or the day after tomorrow, he ends up being elected. Otherwise, of course, the great match is to find a president that keeps him there. Now, the prospects now are better for that, because finally it's very clear that no single group can elect its own president, so they must find a figure that can guarantee everyone.
Which is why you're seeing this consensus and this haggling. So if President Draghi becomes president of the Republic, is there a consensus figure that could actually govern as prime minister that would be acceptable for the markets?
I think that can be found. I think that what is not exactly perceived abroad is that the President of the Republic in Italy is a rather powerful figure. And so I think Draghi, from the Quirinale as President of the Republic, might manage the situation, and there are many figures that could become prime ministers, also in the present government, ministers of the present government.
Yeah, I mean, I understand that, but at the same time, they're not in charge of actually, trying to get the EU funds. So it's still risky.
I don't think that. I think that is more of a. This is a great challenge for the Italian state, the Italian administration, the municipalities, the regions. So I think it's a bigger match than just the idea that if Draghi is prime minister, then everything is going to go well. It's a bit more complicated than that.
Yeah, of course. I mean, everybody believes it. But still, if he's president, I don't know who can actually be a prime minister in a fashion that will make sure they have access to the EU funds. Giovanni Orsina, thank you so much, Director of the School of Government at Luis Guido Carli University in Rome. Now, we'll have plenty more, of course, from Italy throughout the day. Also coming up, we talk Deutsche Bank beating in the fourth quarter estimates. That's coming up shortly, and this is Bloomberg.
We continued, I think, to at least hold, if not gain market share against what was for us a relatively strong fourth quarter of 2020. Now, going into 2022, as you ask, we're actually seeing similar momentum. The markets, of course, have been disrupted in the first few weeks of the year. We feel that we've navigated that reasonably well. We're actually doing a little better than where we were last year. And we continue to see the client momentum we had late last year.
Could we see surprise tightening, surprise moves from the ECB?
Well, our economists on Monday called for the first move to be before the end of the year on the deposit rate, which is ahead of where the market is by far. And in their judgment, it's simply a recognition of the likely persistence of inflation, although it will moderate this year, we think, relative to 2021 as conditions normalize somewhat. The fact that inflation will have lasted longer, and it'll give, in a sense, the ECB an opportunity to begin to normalize the monetary policy environment. That's the call of our economists, certainly something that would benefit our business. But we also think that it's healthy for an economy to end what has been a relatively long-standing sort of condition of negative interest rates. I think we'd all see that as an unnatural condition and one that we would look forward to a normalization in respect of.
Danny Berger's conversation with the Deutsche Bank Chief Financial Officer James von Moltke. Now, plenty coming up. Of course, we'll have a full roundup of your markets. We talk the Fed, we talk the hawkish hilt, and what that means for repricing of the yield curve. We'll have a full roundup, of course, of your market news shortly. This is Bloomberg. Fed liftoff. Jay Powell bakes in a March hike and doesn't rule out tightening at every meeting this year. Market volatility, stocks and futures react to the Fed's hawkish tilt. Money markets are now pricing in 5 rate hikes in 2022. And deadlock here in Rome. The third round of Italy's presidential election yields no winner. Voting resumes today. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Rome. Now, whilst we wait, of course, for a new president of the Republic being elected, all eyes on what the Fed said yesterday and a repricing on the markets. Now, Jay Powell and that talkish tilt from the Fed was pretty extraordinary. Here's what guests have been saying.
The Federal Reserve is starting to understand that they're actually going to have to do something. They probably would have to go a bit faster and a bit further than what people had been anticipating.
The Fed was really late in the game.
They made it clear they're not going to shrink the balance sheet till after they start raising rates.
It's very important that the markets understand what the Fed's doing and why the Fed's doing it, so the market can anticipate the Fed's before the Fed actually acts.
The problem is they still have to deal with inflation.
If we see inflation starting to fall, we know that we've moved into restrictive territory.
Well, for more on the market reaction, let's get straight to our editor and markets editor, Christine Aquino. So, Christine, it is important that the market understand exactly what the Fed is doing. It was pretty clearly laid out. The dollar bulls are back. Are markets understanding what was said?
Well, Francine, I think that's exactly what we're seeing in markets today. Definitely that resumption in the dollar and treasury yields relationship very much back in the picture. And we're seeing again this realization that the Fed is really serious about this. And with that indication of 5 Fed rate hikes also being fully priced into markets, very much the reaction that we're seeing as far as the dollar and yields are concerned. I would note, though, that while we're still in the red here in Europe in terms of equity markets, we are seeing slowly that reversal after that great sell-off in the Fed aftermath continuing this morning. I note that the DAX, while it has been the biggest underperformer here in Europe because of its tech exposure, very much pairing those losses now. We're down to about 0.6% in terms of losses. That was over 1% when we kicked off here in Europe. And I see the S&P futures are also hitting the green now as we speak, again, continuing that reversal theme. And so I think, this is very much kind of we saw markets buying the rumor, selling the fact of the Fed, and now a reversal of that sell-off heading into the U.S. session here.
So, Christine, when you look at some of the, some of the things that we're talking about in the flattening of the yield curve, how does QT, the big unknown, actually play into it?
Well, Francine, I think what really that does to the yield curve is add more confusion to the signals that we're meant to be reading off of that particular measure. I know even before we got into this discussion of Fed tightening this year, it was already there were already doubts over what we should be reading from the yield curve just because of the structural changes that we've seen in bond markets and monetary policy over the past decade with quantitative easing from the Fed and a bunch of other central banks. rise. And so now that we're kind of exiting that era, it's adding to more confusion in terms of the signals that we could read from this. I think it really is correct to say that it's probably not the right time to be reading too much into the curve flattening. And of course, thinking about as well the two-way risks that we could see there, both in the short end of the Treasury market as well as some of these longer duration treasuries, especially once that quantitative tightening process really kicks off this year.
Yeah, so interesting. Christine, thanks so much. Christine Aquino there from our markets team. Now, we're also joined by Ian Steele. He's International Chief Investment Officer for Fixed Income at JP Morgan Asset Management. Ian, you must be busy. I don't know whether it's one of the things that we were expecting in terms of Fed, but this, pretty aggressive repricing in money markets. How many interest rate hikes are you expecting this year?
So I think you've got to look now and say 4 is the absolute minimum that we're going to expect. And I definitely think the risk to that is now to the upside. As you said, the market's pricing in 5. We've now got some expectations, possibility of 50 basis points occurring in March. And it feels like what we need to be aware of now is that every meeting the Federal Reserve has is a live meeting, and they could well raise rates during them. So we need to be focusing on the data, and it's all going to be about the inflation data. And I think Jerome Powell was very clear about that yesterday.
So, Ian, what part of the Treasury curve are you buying right now?
So it's very difficult to get too excited about any part of the Treasury curve. I think, take Christine's points on earlier. The yield curve probably isn't as good an indicator as it has been through history, just given what's going on with quantitative tightening, just given what's going on with still low yields around the rest of the world means that longer dated Treasuries can look attractive to people. It's the 2-year yield that's really kind of caught our attention over the last 24 hours or so, and just the repricing there. And I think that's what you need to continue to focus on, because actually, if it is going to be more than 5, it's 2-year yields that are going to move higher. But for me, can't really get too attractive at owning any part of the Treasury curve at the moment.
Yeah, let's stick actually to what we're seeing on screen. I mean, it's a great chart looking at what's happening historically. If the Fed is going to run these longer dated maturities off the balance sheet, as you're suggesting, and some Fed voices have suggesting that makes a case for steepening. So when do you think we'll be clearer on that?
I think they were very clear yesterday that the main tool for tightening is still the rate, and that is the area that they're going to continue to focus on. And I think they want the runoff to occur, but it's going to be interest rates that they focus on, and that is obviously going to impact the front end of the curve much more than it's going to impact the back end of the curve. So I really think that's where a lot of attention, and that's where we've seen, even today, we're seeing yields higher at the very front end of the curve, actually slightly lower in the longer dated securities today.
Ian, what does this mean for the rest of the world? I don't know whether, for the moment we're seeing a bit of repricing actually in parts of the Treasury market, or certainly the money markets, but what does it mean for an ECB? What does it mean for a Bank of England and also emerging markets?
So I think I'd split them into 2 different components: what's been happening in developed markets and what's already happened in the emerging markets. We obviously saw a huge normalization occur across the emerging markets. We saw 18 central banks in EM hike rates last year to the tune of over 4,000 basis points. So there's already been a lot occurring in the emerging markets. I think this year is all going to be about the developed markets, and I expect that the majority of the developed markets will be following a similar path to the Federal Reserve. And if you look at Canada, I know they didn't hike yesterday, but it was a hawkish message. If you look at what's going on in the Bank of England, that we expect them to hike. It'll be interesting to see in the next couple of weeks from the Reserve Bank of Australia. They're going to change their starts. And then, of course, it's all about the European Central Bank. And our expectation is we could well be talking about rate hikes towards the end of this year. I still think it's a long shot. I mean, they haven't got quite the inflation dynamics that we've got here in the UK or over in the US. But I think they're on that path, and I don't think we should be ruling out those sorts of moves later this year.
I know this is definitely an outlier, call or outlier thinking, but I was speaking to one of our markets editor, Eddie van der Walt, and he was saying, what if this is a hawkish bluff? So, the Fed actually positions the markets to be much more hawkish, but they only raise rates 3 times because then inflation comes off at the middle of, in the middle of the year. Would that be like, a genius coup on how to talk to the markets, run them up and then be seen as dovish?
if you think about what's happened over the last 2 weeks with equity markets falling into correction territory, starting to see a wobble in other parts of risk markets, it doesn't strike me as something that the Federal Reserve would be looking to do, because obviously this could have bigger ramifications. If the market does get concerned that the Federal Reserve is going to over tighten, effectively disrupt the economy, then that could lead to a further tightening financial conditions, a further sell-off in risk assets, and they do want to have some stability around these markets. So I don't think that's the case. I think they are genuinely concerned about inflation. I think genuinely at the moment they're in the wrong place. They would like to be already moving towards normalization, if not normalization already. So for me, I think they're just trying to emphasize that their primary target at the moment is inflation, and that's what they want to focus on.
All right, Ian, thanks so much. Ian Steele there, International Chief Investment Officer for Fixed Income at JP Morgan Asset Management. Now, we'll have plenty more, of course, from the markets after the repricing in money markets, not expecting 5 interest rate hikes from the Fed. Coming up, wooing Italy. Well, Putin holds a call with Italian executives, despite Mario Draghi asking the businesses not to do it. We discuss the relationship between the two nations next. We talk about the elections here in Italy as well. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Rome. Now, we'll have plenty more, of course, on the procedural process of electing a new president. We'll talk also about Italy and Russia. But now, let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned Chinese authorities are considering dismantling Evergrande by selling the bulk of its assets. The restructuring proposal submitted to Beijing by officials in the troubled company's home province calls for the developer to sell most of its assets. The expectations would be its separately listed property management and electric vehicle units. Now, LG Energy Solution is surging on its debut over in Seoul following its $11 billion IPO, South Korea's biggest ever. The company plans to raise production capacity to meet global demand for EV batteries and improve the quality of its cells. It's now the third biggest stock on the benchmark Kospi. And Intel has forecast earnings of 80 cents a share in the first quarter, less than estimates. The disappointing numbers fuel concerns that the chipmaker's turnaround plan will weigh heavily on financial performance. CEO Pat Gelsinger has made it clear that the company is in investment mode rather than prioritizing short-term financial metrics. Apple is developing a feature that will let iPhones accept payment with just a credit card tap. Currently, merchants need to use terminals that plug in or communicate with the iPhone via Bluetooth. Bloomberg's learned that Apple has worked out the feature since 2020 when it bought a Canadian startup that developed that very technology. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, energy giant Enel was among the Italian companies ignoring a request by their government not to take part in a conference call with the Russian President Vladimir Putin yesterday. Now, some commentators have actually raised suspicions about Putin's motives in wooing Italian executives. The country played a key role in opposing sanctions against Russia in 2014 after the annexation of Crimea. Now, to talk about all of this, to talk, of course, about the big thing that everyone here in Rome is talking about, the election of the president, is the Italian lawmaker Lia Quartapelle, member of Italy's Democratic Party in charge of foreign affairs. And she told Politico you can't put industry on one side and foreign policy on another. Well, she joins us now, and I'm delighted about that. Thank you so much for joining us. I mean, I have a million questions to ask you. First, about Russia. Do you think Vladimir Putin is using these executives and, of course, Italian business to get in between him and the government, that actually they will put pressure on the government to be more lenient, whether he invades Ukraine or not?
Well, I think the meeting came at a very inappropriate time and it should have been cancelled. And I think it was the perfect platform for Vladimir Putin to say what he keeps saying, which is not true, which is Italy is so important for Russia and Russia is so important for Italy in business relations. Actually, Russia amounts to 1.2, 1.3 of our general exports. So for certain companies, of course, it's important, but overall for the country, it's not as important. While Italy as a market for Russia is very important, So the leverage is on us, not on them.
But so why did the government, why were they not able to stop it? I mean, they called the companies and said, please don't do it.
Well, this is, there are newspapers today saying that, saying different stories. So I'm not aware, and we're putting forward a question to the government about this to understand how it all went. But I think, I mean, it's a time when we have to be united. Business, politics, government, media, saying the same message together with our allies that Ukraine cannot be touched.
So do you think Vladimir Putin is actually, so of course there's something, you know, with Ukraine that he wants it for nationalistic reasons, but do you think this is also a great way of splintering allies? And this is actually our biggest concern, that Italy will have a fight with France and the US over this.
Well, of course he's trying his best. He's trying with us, he's trying with Germany, and I think we should all say the same thing. There is a time for dialogue, but there is a time to be firm. And this is the time to be firm and united with our allies.
Why have we not been as firm as maybe some people say we should have been?
Because in general, foreign policy in Italy is a matter for those that care about it, while we tend to think that business is something else. But presently, they are exactly the same, and we should be united, and we should ask our firms to be more compliant with the general interest of the country.
When do you think we'll have a new president?
I hope soon. Tomorrow, probably tomorrow.
Do you feel like there's actually a coalescence, and is there going to be a consensus candidate, or do you think Mario Draghi still has a chance of becoming president?
Well, I think he can be a very good consensus candidate, of course, is one of the names we're discussing about. The important thing today is that the right wing understood that there cannot be a partisan candidate, but that we have to be united again, also in this matter, to elect a new president. And this is a very good news for the stability of Italy if all the parties, or the great majority of the parties, vote a new president for the next 7 years.
I mean, if Mario Draghi becomes president, who's likely to become prime minister? And again, would it be someone strong enough technically to keep the government united, but also make sure that Italy continues to have access to the EU funds?
I think we shouldn't run too much. If Mario Draghi becomes president, he is in the position in the constitution to decide with the parties who's going to become the prime minister.
The problem is that the market wants to know. I know, I know there's a speed maybe in politics, but the market is always trying to front run to see what the biggest risk is.
I understand, but I think it's better to decide in the times we need to decide rather than rush a decision which might be a bad one.
But you think, are you confident that you'll be able to find a prime minister that the market supports, or are the EU funds at risk?
Yes, I think so, because if we elect a president, Mario Draghi or somebody else, with the same majority of the government will remain stable. And we don't want to lose Mario Draghi, either as a prime minister or as a president of the republic.
But so you don't think the EU funds are at risk at all? I mean, the EU funds have basically been put in place to really give countries like Italy a chance. We have 191 billion that actually go directly to Italy. If we have political instability, will we still have access to these European funds?
I think the good news today is that we cannot have political instability because neither the right nor the left have the numbers to do a partisan choice. So we will make a choice that is consensual, which is a stable choice. And this will affect, of course, in positive also the way we will spend the European money.
So we talk a lot about structural reforms in Italy and how to transform the economy. What do you think will be the biggest challenge for the president and for the prime minister in the next 2 years?
Well, there is certainly inflation, but there are underlying challenges. One is certainly the position of women in society. Less than half of the women in Italy work, and this is a structural challenge of the country, not of the women. And secondly, education. There is a big mismatch between people that go out to school and the labor market. There is a big level of youth unemployment in the country. So these are the two structural challenges which we have to address.
Has it been addressed at all? I mean, this is what leads to social unrest at the end of the day.
It has been addressed also in the way we will spend the European funds of the Next Generation EU. We put a clause that the new projects have to include people that are either young or women as new employment. And as well, we are using the money to increase the offer of services for care for children.
thank you so much for making the time to come on with this beautiful view. Yeah, Quarta Pelle, they're a member of Italy's Democratic Party in charge of foreign affairs, joining us to talk about the presidential election, but also this complicated and tricky relationship between the West and Russia, especially Europe. Now, coming up, Tesla races past estimates, setting a record for profit, but the EV maker warns of supply chain problems ahead. We have all of the details next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in Rome. Now, we have quite a lot going on. We'll talk a little bit about the markets after the Fed put. We did hear from, of course, the FOMC and Jay Powell. Now, let's get on to Tesla. They came out with earnings. They also talk about a humanoid robot, which I'm quite excited about, not really knowing what it is. And then the other story is, of course, the Cybertruck. If you wanted one, you can't get a hold of it for another 12 months. Let's get all of the details with our Laura Wright. Laura, how much insight did they give us on their supply chain pressures?
Supply chain pressures, Francine, going to remain a problem this year. That's why we're seeing Tesla trading to the downside in pre-market trading. Analysts at Morgan Stanley, they don't see anything truly narrative changing for the bull case. Elon Musk, he tweeted last year about a supply chain nightmare. That said, Tesla, no hit to volume in the long term. They maintain they are on track to reach 50% annual delivery growth going forward annually. So that's a really important note for the investors, Francine, for fundamentals.
Yeah, talk to me about the humanoid robots. Should I be excited? Is it going to make my life easier? Am I going to want one, Laura?
You should be excited. Tesla plowing on with innovation. Forget electric vehicles, forget batteries. This year, Francine, Tesla's primary production focus is robots. And the Cybertruck you mentioned, 2023 is the release date. Who would not want one of these vehicles? I know it's on Matt Miller's wish list this year. And it's not the battery technology that delayed the release of the Cybertruck. Elon wants to make this car affordable so more customers can enjoy it in the long term.
I mean, I kind of love that truck. It's ugly, but it's kind of cool also at the same time. I think that's the attraction that Matt Miller sees in it. So what did we take away from the earnings call? I know there's been a number of concerns also in the management style of Elon Musk. You know, was the earnings call strong enough to turn things around?
It was unclear, Francine, whether Elon would even be on this call. Look, he showed up. He's talking about transformation at the company. Yes, he has been a polarizing leader, thinking about space, thinking about robots. But looking forward, there is a bullish outlook for Tesla and no major changes to price targets or positions from the brokers.
All right, thanks so much, our Laura Wright there looking at Tesla and the humanoid robot. I don't still know what it does, but I need one in my life, especially if it cooks for me. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, he'll have a few thoughts on, of course, the Cybertruck, and Kailey Leinz, both in New York, and Edwards here in London. We have a repricing of money markets, now expecting 5 hikes from the Fed in 2022. So we'll see what that means for the yield curve. A line of thought actually thinking that the yield curve will no longer flatten, but will steepen. We talk QT. This is Bloomberg.
I think what's important about this is the Fed was really late in the game.
The Federal Reserve is starting to understand that they're actually going to have to do something.
It's hard to say that they're hawkish right now, but they certainly are feeling the need.
Yes, it is possible the Fed has fallen a little behind, but the Fed, to some extent, is a prisoner of the new framework.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Thursday, January 27th. Our top stories today. The markets react. European stocks trim declines and U.S. futures wipe out earlier losses. It's a signal perhaps that concern is easing about the Fed's hawkish stance to contain inflation. A big day for earnings. Deutsche Bank posts its best year in a decade, and we'll learn how badly the supply chain crunch hurt Apple. Those supply problems will keep Tesla from unveiling any new models this year. And the U.S. won't back down. Russia's likely to be unsatisfied with the Biden administration's response to its security demands. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. Well, few, Kailey, because things looked pretty gruesome at the start of the trading session here in Europe this morning. But things turning around pretty quickly. More of that stock market volatility we've come to love.
Yeah, turning around in Europe and in the U.S. future session, Anna, but it was too late for that turnaround to take shape in Asia. It was really gruesome in the overnight session. Really, the best way to show that is with the GMM function on the Bloomberg terminal. For our radio listening audience, basically all you need to know is there is a ton of red on the screen. That is true for equities, which were down across the board in Asia. The Kospi in South Korea actually falling into a bear market, down 3.5%, which was about a 3.5 standard deviation move to the downside. You also had the CSI 300 in China falling into a bear market with its 2% decline. Stocks were down 3% in Japan. Really a lot of pain across the board. And that was also true in FX, where every single Asian currency is weaker against the dollar today. You also had a multiple standard deviation move lower for it, both the offshore and onshore Chinese renminbi. That onshore renminbi down about 0.7%. And finally, in the bond market, a lot of selling pressure there too across the Asia Pacific, specifically in the shorter end of the curve across the board. 18.4 basis points higher when it comes to the two-year yield in the Philippines, higher in Singapore, Indonesia, Australia as well. In Australia, that two-year yield up about 7 basis points, Matt, to the highest going all the way back to the summer of 2019.
Yeah, a lot of black boxes on that GMM, so a lot of big moves. In terms of the U.S. market this morning getting set up, we don't see any big moves today, but there are some big moves left over from yesterday. So the S&P futures coming up a little bit. That's not surprising to see a bounce after such a big drop following gains, right? We were positive before the FOMC started and then ended the day 2% lower. This is the big move we saw yesterday. 10-year yields up to 184.23. So we were trading at 177 before the meeting, a jump up of about 7 basis points. The Bloomberg U.S. dollar index also made a big move. We were trading at 1177. Now we're at 1184, 1185 on the dollar index. So some real strength going into the greenback. Bitcoin, it's been stuck in a range. A lot of volatility, a lot of moves, especially intraday. Yesterday, we were up almost to 39,000 and then came back down to end the day. Remember, Bitcoin trades 24/7, even through weekends. But we keep seeing a close around $35,000, $36,000, and right now we're at $36,550. Anna, what are you seeing in Europe?
Right, well, you're seeing something more risk on coming through then gradually in that futures picture over in the United States then, Matt. We're just getting round to that idea here in Europe. We started off really in negative territory, down by nearly 2% on some of these markets. This was flashing bright red on this Europe map just a couple of hours ago. Now, less so. Now, much more mixed. And in fact, we have the FTSE 100 up by 0.4%. There are a lot of value plays in the mix here in Europe. A lot of the banking names doing pretty well in the UK market in particular. Let's move on and show you what's going on fixed income markets, because as Kailey and as Matt have been talking about, we're seeing selling of stocks, we're seeing selling of bonds, we're seeing yields go higher, and that applies here in the United Kingdom as well. So we do see the yield going higher as investors increasingly factoring in rate hikes coming through from the Bank of England, and the first of those, it looks as if, is priced in for next week. 111.99 is where we trade on euro, down by nearly 0.4%. It's really a dollar story, dollar strength on the back of those higher yields in the United States, but it is taking its toll both on the pound and here on the euro. A couple of corporates to focus in on. I mentioned the banking sector doing well, one of only a few sectors doing well actually here in Europe, and banks are to the fore, making the most of those higher yields that we're talking about, but also the stellar set of numbers coming through from Deutsche Bank, a much more optimistic outlook, the best year in a decade from the business, higher rewards to shareholders, all the right messages. That stock flies up 5%. SAP, it's a tough day to be a tech stock, a tough day to be a cloud computing business, and that stock down by nearly 6%. They confirmed their earnings picture, but didn't upgrade any outlook guidance, Kailey, and that's something that's weighing on that stock. That could have read across into the US session.
Yeah, absolutely. Considering it isn't just a tough day to be a tech stock, it's really been a couple of weeks to be a tech stock. We'll see if that can turn around today. We have a number of events we have to get through today. First, though, President Biden will hold his second U.S.-hosted meeting of the Major Economies Forum on Climate and Energy. Also later on, U.S. GDP is reported at 8:30 a.m. New York time. And finally, speaking of tech, we get continued earnings. Apple will be reporting after the bell today, 4:30 p.m. New York time. And of course, that's a stock already down 10% so far this year, Matt. We'll see if the iPhone maker can turn things around with its results today.
Yeah, definitely be watching that closely considering the supply constraints. Now, the Fed is making it clear it's ready to act as needed to cool the highest inflation in a generation. Chair Jerome Powell spoke yesterday.
The committee is of a mind to raise the federal funds rate at the March meeting, assuming that conditions are appropriate for doing so. I think there's quite a bit of room to raise interest rates without threatening the labor market. We'll need to be nimble so that we can respond to the full range of plausible outcomes.
All right, so some legit jawboning there and leaving their optionality open, certainly in terms of upward movement. Ven Raam, cross-asset strategist for Bloomberg Markets Live, joins us now. So, Ven, now the market is pricing in 5 rate hikes this year as well. Does it look like the Fed's really going to go through with it?
Well, I think that we'll at least get 4 hikes this year. I'm not too sure about 5 hikes. But what the Fed has achieved yesterday was quite stellar, and they accomplished a lot yesterday. The December dot plot showed 3 rate hikes this year, 3 next year, and 2 in 2024. With one fell swoop, Powell said that, look, it's going to be a lot more than 8 rate hikes in this cycle. And that's why we have seen the kind of reaction we have seen in rates and the dollar.
Ven, good morning. It's interesting to think about what we heard about quantitative tightening and how little emphasis perhaps the Federal Reserve is going to put on it. They certainly don't see it as a substitute for increasing interest rates, another hawkish element to what we heard from the Fed.
Absolutely. If previously the thinking was that if they are going to run off the securities off the balance sheet, maybe that amounts to 1 hike, maybe we'll get 3 hikes and plus quantitative tightening. And now he's saying that, no, look, that's not going to be the case, which means that it's probably 4 hikes plus QT. And that's quite a lot for the market to grapple with, and which is why we have seen real rates climb higher. And I think that's the trajectory for real rates this year. It's going to keep climbing a lot higher. And we have already taken out the highs in the past 1 year.
All right, thank you very much to Ven Raam of Bloomberg Live. Those real yields are up about 54 basis points so far in 2022. Now let's turn to tech earnings. Tesla posted a record profit, but the electric car maker warned it won't be introducing new models this year. Let's get more on this with Bloomberg's Laura Wright. And Laura, bad news for Matt Miller. He won't get a Cybertruck until 2023.
You're right, he won't get a Cybertruck until 2023. But the good news is it will be more affordable for Matt Miller. You can't complain about that with inflation where it is. Tesla trading to the downside in the pre-market because the supply chain is going to remain a problem in 2022. That's why Elon Musk actually bothered to join this earnings call. He's tweeted about the nightmare that is taking place. Robots also on the agenda. That's going to be the primary focus production-wise for Tesla this year. Now, Intel chip maker reporting yesterday, gross margins are going the wrong way. You would think with demand at elevated levels, prices would rise, gross margins should be increasing, but Intel is being beaten at its own game by a competitor, AMD, in the computer chips world. After the bell today, the world's most valuable company, Apple, to what extent has the supply crunch impacted Apple's ability to make shipments? Apple trading positively in the pre-market, but customer is king, especially when you are the world's most valuable company. So Apple, the analysts believe, will be mitigated somewhat because they are prioritized by their suppliers, such as TSMC.
Yeah, we're going to definitely be watching Apple closely and waiting for any updates on the Cybertruck. By the time they come out with one, Ford, GM, Rivian, are all going to be on the market. So they got some really stiff competition, though nobody has such an angular product. Laura Wright, thanks so much for joining us on that. Later today, don't miss our interview with the CEO of Intel, Pat Gelsinger. That will be important market intelligence for anyone invested in chips or in tech in general. And another earnings story, Deutsche Bank raised its revenue guidance after reporting its most profitable year in a decade. The CFO, James von Moltke, spoke with Bloomberg's Danny Berger this morning.
Going into 2022, as you ask, we're actually seeing similar momentum. The markets, of course, have been disrupted in the first few weeks of the year. We feel that we've navigated that reasonably well. We're actually doing a little better than where we were last year.
All right, so Deutsche Bank not only knocking it out of the park with profit, they're also going to be raising their dividend again. They just reinstated that after 3 years on hold, so they're going to be giving money back to shareholders and getting their cost-income ratio in order. The CEO says he thinks 70% is just around the corner.
Yeah, absolutely. So some positive messages coming out of Deutsche Bank. That's certainly lifting their share price. Worth noting, it's not just that bank that's moving higher, though, in European trade. We've got banks in London moving higher. So it fell into a favourable environment, it would seem, that news flow for a banking stock. So Deutsche moves higher, Standard Chartered, HSBC, NatWest, Barclays, all moving to the upside, Kailey, in this morning's session.
Yeah, and of course, that conference call for Deutsche Bank is ongoing. The CEO, Christian Saving, speaking right now. He says they're not thinking of M&A this year in 2022, but also they're not blind to opportunities. So we'll continue to bring you any highlights from that call. But we also want to get over to Washington. Some Republicans are promising a pitched fight over President Biden's next Supreme Court nominee, a battle that will mean more for the midterm elections than it will for deciding who replaces Justice Stephen Breyer on the bench. Let's go to Jack Fitzpatrick, Bloomberg government reporter, who joins us now from Washington. Jack, how bitter could this fight get?
It's a really important issue for Republicans. Obviously, we've seen over the last few years that Supreme Court nominations, really court nominations in general, are one of the most important things to Republican voters. Heading into a midterm, that makes it kind of an explosive issue, especially with the Supreme Court consideration on Roe v. Wade. Then again, Democrats do have the 50-50 Senate and a tiebreaker in the vice president. And when you look at the recent results, nothing has gone badly for them in terms of court nominations, really. Ketanji Brown Jackson, who's considered one of the frontrunners for this spot, was confirmed to the D.C. Circuit Court of Appeal with 53 votes. They didn't lose any Democrats on that vote just last summer. So they can get something through if Democrats circle the wagons and nothing takes them by surprise.
OK, so we'll watch the Supreme Court. Also on the radar, of course, global geopolitics then, Jack. If what we're seeing on the Ukrainian border is all about limiting the ambition of NATO, Russia may be disappointed in the response they've had to their demands from the United States.
Yes, the U.S. response yesterday to Russia did not give up any concessions on the idea of redrawing NATO borders, on precluding a possible inclusion in the future of Ukraine in NATO. The offers were more along the lines of more transparency among countries on military exercises, things like a possible arms control deal. It was not the big stuff that Russia was looking for. So really, ultimately, despite the U.S. written response yesterday, nothing fundamentally has changed in the U.S.-Russia conversation as it relates to Ukraine.
Well, we know you'll keep us up to date if there are any fundamental changes. Thank you so much to Jack Fitzpatrick of Bloomberg Government. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. A big one to the upside is Qualtrics. The software company reported after the bell last night. Revenue topped expectations, guidance topped expectations, and as a result, that stock is up more than 11% in pre-market trading. Also moving higher after reporting yesterday is Levi Strauss. Topped expectations, really strong sales guidance. They say price hikes are not affecting consumer demand. Apparently, people are really paying up for their blue jeans, and as a result, that stock also is up about 8.3%. And finally, Netflix is also moving higher. This is not an earnings story. We know how that went yesterday. Instead, this is on news that Bill Ackman is now an owner of more than 3 million Netflix shares. That makes Pershing Square a top 20 shareholder, and on that news, that stock is up nearly 5% before the bell, Anna.
Yeah, Bill Ackman buying that dip then. Let us tell you what is coming up on the programme. Seema Shah, Principal Global Investors Chief Global Market Strategist, will get her perspective on what we heard from the Fed, that hawkishness from the Fed. How anticipated did she see it as? Not so much, maybe is the market's verdict. Plus, an electric future. Renault chairman Jean-Dominique Senard talks about the automaker's new EV roadmap later this hour. And later today, an exclusive interview with the CEO of the world's biggest wealth fund, the Norwegian Sovereign Wealth Fund. Investments in tech and financials driving gains at the fund. What does Nikolai Tangen make of market volatility? That's at 7 p.m. New York time, 12 p.m. here in London. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kailey Leinz in New York, Anna Edwards with us out of London. Now, the Fed may be willing to let stocks slide another 20%. That's the latest from Bridgewater's co-CIO Greg Jensen. In an interview, he said some decline in asset prices is not a bad thing from the Fed's perspective, so they're going to let it happen. The idea is you had a lot of speculative bubble buildup from the cash injections and loose monetary policy, and now that they're reducing that, you can expect to see levels fall in terms of valuation. Joining us now is Seema Shah, Chief Strategist at Principal Global Investors. I thought this was a great interview with Greg Jensen, great piece out of Bridgewater. And it makes a lot of sense. The Fed doesn't seem as worried, or didn't yesterday seem as worried about market levels. What do you think, Seema?
I'd agree. I don't think that that's something that's concerning them, especially when you consider that financial conditions haven't tightened too much. But the thing that I did also take away from it was that the Fed is quite confident about the economic outlook. Right? They do think that the economy can digest all of these rate hikes. The labor market is strong enough. And actually, we should take some reassurance for that. It does mean that we have this solid backdrop. We continue to see that earnings have been a little bit disappointing, but they're still posting positive growth. And so for us, I don't think we would share that negative outlook for equity markets.
Okay, Seema, that's interesting because I read one view this morning that suggested the only reason we don't get aggressive hiking in 2022 is if the economy spirals into a recession. If it is that binary, if there are only those two outcomes, neither of them would sound that good for risk assets.
No, well, I think there's a path in the middle, let's say. So, I think that 4 rate hikes is doable. I don't think the economy is going to drop on its feet just off the back of that. You're taking base rates just to 125. You look at the earnings growth, you look at consumer resilience, balance sheets, and to us, this is still quite a positive story. Now, with valuations very extended, of course, rate hikes are a threat, but it does mean that earnings growth is still very important. Now, if we were to see that deterioration in the economic outlook, you were to see wage pressures building up, really hitting companies, then we would be certainly more concerned about equity markets. But actually, we do envisage there should be stabilization in the coming weeks.
So we do see, Seema, we do see the Fed then hiking into weaker growth just because of how strong growth was last year. I guess that is something we'll just have to expect and have to see how that plays out. But what kind of earnings story is the Fed hiking into then? Do you expect things to improve or deteriorate from here?
So what we're anticipating is we are expecting certainly a slower earnings growth story than last year. 46% annual growth last year. It's almost impossible to repeat that. So we are seeing single-digit growth for this year, kind of somewhere between the 5 to 10%. It sounds really, really low, but actually that is what you need just to keep equity markets going. So we are hopeful. We think that there's a lot of kind of specific picking and diversification to be done across portfolios, given that conditions are becoming more challenging. But as I said, we are not very, very concerned about the earnings outlook.
Well, obviously, we're in earnings season now, Seema. Technology is really what's in focus at the moment, and tech has had a very painful 2022 so far. How do you differentiate where is safe to be in tech right now and where is not?
Yeah, and it's such an important question for tech because that is the area which is going to be the most challenged with rising interest rates. So I think for us, we take it back to what are the key concerns for the global economy this year? It's about, I think, profit margins. We know that they're very, very wide, so there's going to be some pressures coming through from there. We can see costs are very high and wages are going up. So really, you need companies that have got pricing power. You've got very strong balance sheets, and that's when you start to think about quality. So from that perspective, it's actually there's mega cap tech stocks which do look a little bit more resilient than your profitless tech, which have been absolutely beaten up over the last few weeks.
We've seen a couple of interesting playbooks out the last couple of days from big hedge funds. Paul Marshall, for example, moving back into value stocks and getting short growth. This rotation seems like every year we expect this to happen. Jensen and Bridgewater saying they think it's more appropriate to increase commodities holdings, trade out of U.S. stocks, and use break-evens to fight inflation. What's your playbook for this year?
Yeah, look, I think like everyone else on the street, we've been doing a ton of analysis into the growth value trade, and is this the time to be rotating fully into value? Now, when we look at it and we look at the very significant moves that have already happened and we look at valuations, actually, there isn't a very strong signal for either. So from that perspective, we still think quality and we still think big balance sheets, again, within both your growth and your value. So there's a full diversification. The key difference that I think we have to a lot of the market is actually we still prefer the US. We still think that, look, when conditions are becoming difficult, it's the US that you want to go to. When you're thinking about Fed tightening and the lack of liquidity, it's emerging markets that struggle the most. So for us, it's still the US, which is going to be the strongest outperformer for 2022.
All right, Seema Shah, sticking with the U.S. story, Chief Strategist at Principal Global Investors. Thank you so much for joining us this morning. Now let's get a check on the first word news. And in China, authorities are considering a proposal to dismantle the struggling property developer Evergrande. Bloomberg has learned the plan calls for Evergrande to sell off most of its assets, except for the property management and electric vehicle units. It would be China's biggest step yet to prevent a disorderly collapse of the world's most indebted developer. Omicron has led to a new era for pandemic management. Outbreaks are peaking and ebbing more quickly, allowing some countries to remove restrictions within weeks. The new Bloomberg COVID resilience ranking has the UAE, Saudi Arabia, Finland, Turkey, and Singapore as the best places to be in the pandemic. The 5 worst: Argentina, Russia, Romania, Vietnam, and the Philippines. North Korea has added to the biggest barrage of missile tests since Kim Jong-un took power a decade ago. It fired what are believed to be 2 short-range ballistic missiles today. It's the 6th missile test since the start of the year. North Korea has warned the U.S. it may end its almost 5-year halt on tests of nuclear devices and long-range missiles. And a new warning highlights the growing risk from space junk as companies plan to launch thousands of satellites. Astronomers say that debris from one of Elon Musk's rockets will crash into the moon in March. The Falcon 9 rocket was launched in 2015. Musk's SpaceX is in the midst of expanding Starlink, an internet network that will eventually total more than 30,000 satellites. Matt Miller, to the moon, literally.
Yeah, absolutely, and smashing into it, although I think space might be big enough to accommodate some junk from our tiny little planet relative to, what is it, like 50 billion light years wide? I think it'll be okay.
You think so? That's all right then. I'll take your assurance, Matt Miller, because I have to say it scared me a little more. The space junk, but also the number of satellites that Musk and others are putting into
space is very
low Earth
big.
Orbits.
It's quite large.
Very big. You heard it here first. Right, coming up on the program, we'll discuss the Fed with Samin Soa Power, head of inflation trading at Bank of Ireland. Lots to talk about when it comes to inflation. Economists have not necessarily covered themselves in glory in predicting the levels of inflation that we've achieved. So much was unforeseen about the level of savings built up during the pandemic and what consumers would exactly do with all those built up savings. As we unwind some of that, as inflation comes down, what is our expectation for how fast that happens, and crucially, what that does to the Fed's path? Could we see inflation unwind to such a degree that the Fed backs off from some of its more hawkish rhetoric later on this year? We'll get into that conversation next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Here's what you need to know. Traders are ramping up their bets for higher borrowing costs. Money markets are now expecting the Fed to raise interest rates 5 times this year. They're also expecting another 4 hikes from the Bank of England. The world's biggest hedge fund sees a much bigger drop in stocks before the Federal Reserve blinks. Bridgewater's co-chief investments officer Greg Jensen says stocks could fall another 20%. He tells Bloomberg that some decline in asset prices isn't a bad thing from the Fed's perspective. Deutsche Bank has raised its outlook after its most profitable year in a decade. Meanwhile, Tesla set a record for profit, but it's warning that supply chain problems will keep it from introducing new models this year. And after the bell, we'll see what sort of impact those supply issues have had on Apple. Lots to talk about then, Matt, when it comes to the earnings story. What do we need to know when you look ahead to the U.S. session?
Well, it would seem that we're a little bit more risk on here, certainly than we were yesterday, although S&P futures coming back to unchanged now. So, with the volatility that we've seen, it's hard to make a call at this time. We do have relatively high levels on the 10-year. Now we're up at 184, 183.70 to go out 5 significant digits. And NYMEX crude is holding at $87.58 a barrel. We also have a relatively strong dollar. The Bloomberg Dollar Index right now up at 1184, so pretty strong comparatively. Well, there they brought it up. The control room is on it today. Bitcoin, as I was telling you earlier, we've seen such big moves in Bitcoin, up to 39,000, down to 33, but it seems that we keep landing around 35, 36,000. That's where we're trading right now at 36,532. The good news is it's been a good risk indicator, so maybe it's risk on today for U.S. stocks. Kailey?
Matt, the control room is always killing it. It's really the people who aren't on camera who really make the magic happen on this show. They're going to make the magic happen. Put up my board right now. I'm taking a look at some of the tech stocks moving off the back of earnings in pre-market trading. Of course, we've been talking about Tesla. Matt's not going to get a Cybertruck until 2023. Maybe he'll get one of the other EVs trucks out there on the market before that. But Tesla did report a record quarter of profitability. It's really just the supply chain issues and the impact on production that's weighing on the stock this morning. It's down about 1 percentage point before the bell. Also lower is Intel. Disappointing profit forecast. That turnaround that Pat Gelsinger is trying to orchestrate is probably going to weigh on the financial picture for the company. And in fact, on margins, that stock is down about 2.6% before the bell. But we will hear from Apple after the bell today. It's down 10% coming into the print, down actually 7 days in a row. But this morning in pre-market trading, Anna, it's up about 0.8%. So maybe a little bit more positive sentiment as we head into those numbers.
Yeah, I'll get to the corporate stories in Europe in just a moment. Talking about the big picture, though, we have seen Europe recovering from some heavy selling at the start of trade to claw back some of those losses as we've gone through the session. The banking sector moving to the upside, technology stocks an area of weakness. It is the fixed income story that is still guiding things, though, here in Europe. And we've got the 10-year yield here for UK gilts because, as we mentioned in our What You Need to Know segment a little earlier on, we're seeing not just a reassessment of how many hikes we see from the Fed this year, but also from the Bank of England. And as traders look to the Bank of England to hike, they're expecting that to happen as soon as next week. The euro under pressure as a result of those higher yields, certainly at the short end in the United States, pushing money into the dollar. That has a negative impact on the euro. The euro down 0.4%, quite a substantial move for the single currency. Deutsche Bank moving up by 4.8%. It is a good day to be a bank here in Europe. Banks moving higher. There's the yield story, but there's also the numbers put forward by Deutsche Bank. The best year in a decade, upgrading guidance, the dividend story moving in the right direction. SAP, on the other hand, not able to upgrade their guidance this morning, and that weighs heavily on this business, this business that operates, of course, in the cloud. Kailey.
All right, Anna, well, really overhanging all of the markets today is what we heard from the Federal Reserve yesterday, indicating it is ready to tackle the highest inflation in a generation, even if that means potentially hiking every single meeting from March. Listen to what Jerome Powell had to say about inflation yesterday.
Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. These problems have been larger and longer lasting than anticipated.
Now, back in December, Powell cited the Employment Cost Index as a key reason for the central bank's pivot to a more aggressive stance on inflation. We're going to get that data tomorrow, and it is seen registering a fourth quarter gain nearly on par with the record increase in the prior 3 months. Joining us now for more on inflation is Shemin Shower-Power, head of inflation trading at the Bank of Ireland. Shemin, when we think about the inflationary forces that matter most right now, is it on the employment and wage side?
Oh, definitely. As Jay Powell mentioned yesterday, due to Omicron, we are seeing supply chain issues linger for longer, but definitely the game changer for Fed has been how fast the tightening in the labor market has been. And keep in mind that unemployment rate is already below the neutral unemployment rate NAIRU that Fed is seeing at 4%. And we totally agree with Chairman Powell that near-term inflation risks are still on the upside. We are already at 7%. Near-term, we are expecting to see further increases to 7.2%, 7.4% later in Q1. So inflation will not decelerate very quickly. As you said, wages are likely to add still further upside to inflation near-term.
Chairman, one of the reasons we go to you is your expertise on inflation. I'll say again, you were the best inflation forecaster last year. What are you looking at for 2022, and how does the Fed work to fight that?
So Fed was obviously very hawkish yesterday, especially in the Q&A. And it does make sense that they want to have the optionality to react to inflation surprises on the upside, which Chairman Powell told us is something they see as likely. So now market sees 4 rate hikes this year as the floor. At the same time, the Fed wasn't as hawkish as they could be on the timing of QT and possible sales.
But what's your forecast for inflation, Chairman?
Well, as I said, we are still expecting further upticks in Q1. And as we discussed previously, due to energy-based effects, we are actually expecting the levels to come off from about 7% levels from Q2 on. And obviously, we are also seeing downside risks on the growth side. So Fed is hiking into a slowing growth environment. And especially after Joe mentioned pushing against Biden's Build Back Better plan, U.S. growth projections for are still being revised lower. We still actually agree with the market price action that the real rates are leading the sell-off. Obviously, last year we were in an environment of reflation. So even when nominal rates were selling off, real rates were still rallying with inflation expectations widening. But now where we are is more of growth momentum fading, peak fiscal and peak growth in U.S. is behind us. We are actually expecting to see the sell-off in rates to be led by real rates, as we are seeing in the market now. And we still think there's further downside for long-end break-evens because Fed's hawkish message is limiting the probability of future inflation overshoots.
Chairman, can I ask you, thinking of the inflation overshoot, can I ask you how quickly inflation does come down? What kind of numbers are we talking about for the second half of this year? Because we've had the initial sticker shock around a number that starts with a 7. You've suggested we'll keep seeing numbers that start with a 7 for a little while. But how much relief will we get in the second half of this year, do you think?
Market forecasts are closer to 3% handle for late 2022. But again, there are lots of risks on the upside. So looking at what's happening in the energy markets, we are seeing Brent at the moment about $90 per barrel. With Ukraine-Russia conflict, there could be further upside pressures coming from there. On the labor market, as we mentioned, it's super, super tight. So we are expecting to see further pressures on that side. On the housing, on OER, rent, there are obviously further upside risks coming from the housing market. So risks are definitely on the upside. And we also need to see the growth momentum in the second half of the year and how sharp the slowdown will be and how the risky assets will be able to absorb Fed's new message of minimum 4 hikes plus QT kicking in probably in second quarter as well, and how the market will be able to digest that and reflect it in pricing.
Chairman, thanks so much. Chairman Soa Power, Head of Inflation Trading at Bank of Ireland. Thanks for bringing us your thoughts with her expertise in inflation forecasting. Coming up next on the programme, we'll get back to the autos conversation. Renault Chairman Jean-Dominique Senard talks to us about the automaker's electric future. This is Bloomberg.
we see the infrastructure and the customer adoption of full electric cars growing exponentially. And that's why hybrids for us, for that 5-year period, are the perfect solution to bridge for those customers that can't yet live with a full BEV and all that that entails. So we have a dual strategy, electrified totally, but with different degrees, and then fully electric by 2030.
All right, that was Adrian Hallmark, Bentley's CEO, talking about the company's electric vehicle strategy and the fact that it will completely phase out gasoline engines. This is something we've been hearing more and more from manufacturers. Renault and Nissan are investing an extra $26 billion in the next 5 years on electrification. This will lead to 35 new EV models by 2030. And joining us for more now is Jean-Dominique Senard, the chairman of Renault. Jean-Dominique, thanks very much for your time. Let me just first ask you about the combustion engine, gasoline engines. Are they, for you also, going to no longer be produced in the next 10 years?
Well, obviously, the manufacturing of ICE powers will fade away during that period, but it will not totally disappear. Of course, you have to understand that some regions of the world will be really electrified, and that is notably the case of Europe. But the rest of the world will still have to rely on some sort of production of the sort of ICE power.
Yeah, of course.
Yes, clearly we are moving in the direction of electrification. By the way, we announced that Renault would be in Europe 100% EV, pure EV in 2030. So on that part, there is no question. Then you understood that Nissan would also announce that 100% of their production would be electrified in 2030, which means there will be EV and HEV, PHEV. And also Mitsubishi, part of the alliance, announced that they will have a major shift towards electrification. What that means is that we are now having a very solid, strong strategy toward electrification, investing a tremendous amount of money, as you said, more than $26 billion in the coming years. We already invested more than $10 billion, probably $12 billion in the past 10 years, which means that we have, all in all, a tremendous amount of resources that has been optimized between our three companies. And so this amount is very significant, and it reassures us that we will be on time with the right production to serve the market where it's needed. And I can tell you we are now very optimistic, and this is what we shared with the public this morning.
Well, and it's a longer term overview. In terms of the market right now, we've heard some pretty disturbing figures for production. I think German car production is at a 21-year low. The UK had its worst year since 1956. Of course, all this has to do with the supply chain problems and the shortage in chips. How are you feeling that shortage right now? And, what does 2022 look like to you in terms of chip delivery?
Well, we suffered, all of us in the automotive industry. So you know the figures. I don't need to come back on that. It's been really an ordeal and a real crisis to go through. Listen, I am probably a bit more optimistic towards the end of this year. We have to be careful because we all live in a very, very chaotic world, and uncertainty is the rule of the day. But the first half may be still a bit difficult, and we'll certainly have some crisis to manage, all of us, I have to say. But I'm honestly a bit more optimistic for the second half. At least at some point, capacities will reach ground, and that we will be able to supply our factories. So all in all, I mean, we are very cautious for the year, with probably a more optimistic view on the second half.
Okay, more optimistic in the second half. Good morning to you. What about your pricing environment and your ability to pass on higher prices, which no doubt you're experiencing, to consumers? Are you concerned that with consumers facing inflation in many directions, that's going to be something that weighs on the sector?
Well, yes, we have to face reality. I mean, clearly, and notably when we speak about electrification, we all understand that the cost of these cars is higher than the IC technology. It's a fact of life. So in some regions, I mean, we are helped by state subsidies for the consumer to pay their cars at a more affordable price. But in a sense, the groups like Renault, Nissan, or Mitsubishi have no other choice but to increase the prices to make sure that their, I would say, their competitiveness and profitability remains at the right level. We are, by the way, improving dramatically in that direction. So far, so good, I would say. We will do everything we can to avoid that the consumer suffers too much. It's really the point here. But in a sense, we have to absorb the dramatic increase in raw material prices that we've experienced in the past weeks. That's just facts of life. We will do our best to be more and more competitive so that we can keep the prices under pressure so that we can be affordable. But be sure that not only we will have to make our duty in terms of competitiveness, but we will take care about the customers. That's obviously the most difficult part of the year to come.
Jean-Dominique, we continue to monitor the supply chain challenges. We're also continuing to monitor geopolitical challenges. And when we think about the tensions at the border of Russia and Ukraine, potential sanctions that could result, how do you see that potentially impacting sales in Russia and your investment plans there?
Well, so far there is no impact of this crisis. Now, I mean, honestly, I have to be cautious about the coming weeks because none of us really know the outcome of this crisis as we speak. There are some consequences on the Russian currency, as you know, but at the same time, the price of oil is increasing, the price of gas is increasing, which increases the revenues in Russia. So all in all, it's a bit early to have a perfect view and a perfect balanced view of the impact in the country. As we speak, we don't see any major impact. Obviously, early days. We are monitoring the situation very closely, but I don't think that because of the nature of the products that we are bringing to the Russian market that we should suffer too much, because honestly, we are producing now, notably through the Lada
Jean-Dominique,
exactly what the Russian customers need.
Would you stop doing business with Russia if they invaded Ukraine?
The question is not there. We have a huge investment in Russia. I mean, we have more than 40,000 people working for the group there. I mean, we are totally conscious of the situation, but we have to take care about these people. We are producing internally in Russia, and it's clearly we will remain in that situation. I mean, we will monitor the global crisis, but as a company, we have to make sure that we take care about the people who work for us.
Jean-Dominique, thank you for your time. Jean-Dominique Senard, the Renault chairman, thanks very much for joining us. Coming up on the programme, we'll talk more about the chip shortage. In fact, later today with the CEO of Intel, Pat Gelsinger. That's at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. And also joining us, Tom Keene, co-anchor of Bloomberg Surveillance, coming off the late shift with the Fed special yesterday. Tom, what's different this morning that wasn't true at 2:29 p.m. yesterday?
What's different right now is the dynamics of the market, and particularly the fixed income market. I looked at a bunch of dynamic things you can do on the Bloomberg, Kailey, including trading envelopes, standard deviation studies, et cetera. And the one thing that really shows here is the movement that we've seen in the real yield. Someone like Jeff Yu at BNY Mellon says this is what he's watching. Many other people agree with Mr. Yu. So you look at the 10-year inflation-adjusted yield, and the answer is we are at negative 1.20, and we've already made it up 46% of the way back to that zero level. I think the story here is how rapidly we are advancing.
I think the interesting takeaway in terms of what to do with this came from Greg Jensen, the CIO at Bridgewater, who said, forget the 60-40 portfolio as he sees bonds, the 10-year going to 3.5% or 4%. He said, go back to the stagflation playbook of the 70s, buy commodities, get away from U.S. equities into international, use break-evens to guard against inflation.
Everybody's got a different opinion, Matt, and that's what makes us go. That's what makes surveillance go every single day. Steve Englander publishing this morning going completely opposite of Bridgewater and reaffirms the idea that this is a Fed that will confront a lesser inflation and confront it rapidly. That seems to be the mystery this morning.
All right, Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. He'll be continuing to delve into the mysteries of this market throughout the next couple of hours. And as for what else we're watching throughout the day, I will be watching Apple earnings after the bell. The question is, how much did supply chain issues, chip shortages weigh on how much this company was able to sell in the holiday period? It's already down 10% year to date, Matt. We'll see what happens when it reports after the bell.
I will be watching Surveillance. We have an exclusive interview at 7 a.m. New York time with the CEO of the Norwegian Sovereign Wealth Fund. It's the world's biggest wealth fund. It's the world's biggest holder of equities. And Nikolai Tengen, who is the CEO, has warned once again, really something along the lines of what we heard from Jeremy Grantham, that the Goldilocks period is over. He said that they won't be able to make the same returns that they've been making in the past, 25 years. And by the way, they had incredible returns in 2021, as did a lot of equity long holders. $176 billion they made on their $1.3 trillion. So not bad, a 15% return.
We will tune in for that. We're also focused on the Italian presidential race. Still no answer to who becomes the next president. From a market perspective, the question is, will it be Mario Draghi, the current prime minister? Things look more difficult for him to secure that position, but we still have no news on that. We wait to get a bit more clarity on that as the day progresses. This is Bloomberg.